Another technical limitation of profit maximization is that it ignores the quality aspect of benefit. This can be made clear with the help of the example given the table. Depression, alternative 9,000, 0, normal 10,000, boom 11,000, 20,000. It is worth to point out that the cash inflows precise the concept with a definite meaning compared to the accounting profit, which is and can be interpreted in different meaning by different people. Hello my dear students, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Grade College at Temple of Excellence, MYSURU. In this session, I am going to hand Financial Management 4th Semester Unit 1 Session 2 in favor of BBA, Introduction to Financial Management. So, quality aspects of the benefit. Another technical limitation of profit maximization is that it ignores the quality aspect of benefit associated with a financial course of action, that is, profit received is in normal, boom, or in a depression state of economy are different. The term quality refers to the degree of certainty with which benefit can be expected. The more certain the expected return, the higher the quality of the benefit, or the more uncertain or fluctuating the expected benefit, the lower the quality of the benefit. The investor expects steady returns and they want to minimize the risk. The profit maximization objective considers only the size profit. The degree of uncertainty associated with it is completely ignored. This can be made clear with the help of the example given the table. Depression, alternative 9,000, 0, normal 10,000, boom 11,000, 20,000. Then it is clear from the table that under normal condition, both alternatives are giving the same profit, that is rupees 10,000 each. Under depression, alternative A can provide rupees 9,000 compared to zero profit from alternative B, and under boom condition, alternative A is giving rupees 11,000 compared to rupees 20,000 by B. This is as per the table. In other words, the earning associated with alternative B are more uncertain or risky as they fluctuate widely depending on the state of economy. This is important. Obviously, alternative A is better from the point of risk and uncertainty. The profit maximization objective fails to reveal this. It is clear from the limitation stated above that the profit maximization concept, vague and not clearly defined, it also ignores three important aspects of financial, and namely, what are the three important points are? One is the risk, one is the time value of money, one is the state of economy. These 3 points to be bear in mind. Therefore, an appropriate operational decision criterion for financial management should be precise and exact, be based on bigger the better principle, consider both quantity and quality aspect of the benefit. This is important. Recognize the time value of the money, the other objective of the financial management, that is wealth maximization. These technical limitation has been explained below. This is also known as value maximization or net present worth maximization. Objective is universally accepted as an operational decision criterion for financial management because it satisfies all the three requirements of a suitable operating objective of financial course of action, namely exactness of quality of benefit and the value of money. As per the objective, the value of an asset should be viewed in terms of the benefit they can produce. This is important. The value of an asset should be viewed in terms of benefit they have produced. The net worth of course of action can be calculated by total cash inflow minus the investment. Whatever the cash inflow, deduct the investment, it becomes more, you are the surplus. This calculation is the precise estimation of the benefit associated with the course of action. Thus, wealth maximization criterion is based on the sum of cash flows generated by the decision rather than the accounting profit, which is basis of measure for profit maximization. It is worth to point out that the cash inflows precise the concept with a definite meaning compared to the accounting profit, which is and can be interpreted in different meaning by different people. This is the first operated feature of the wealth maximization objective. The second important feature of the wealth maximization objective is that it cannot both the quantity and quality dimension of benefit. This is important. Both quantity and quality dimension of benefit. At the same time, it is also compare the time value of the money. This is done by discounting the cash flows. This is made with the help of the following example. So this is NPV. NPV means net present value. Assume that project it costs 2,600 is expected to generate cash inflow rupees 900, rupees 800, rupees 700, rupees 600, and rupees 5. For 5 years, the cost of capital is 10%. Cost of capital means here it can be do like this, no. It can also do that, no. NPV 1 divided by 1 plus r to the power of n. This is nothing but 1 divided by 1.10 to the power of first year, second year, third year, fourth year. If we divide like this, no, here all these C1, C2, C3 are expected cash inflows. 1 divided by k to the power of 1, k to the power of means the rate of interest is 10%. Here 900 divided by 1.10, 800 divided by 1.10, 700.1.10, 600 1.104, 500 minus 2,600 investment. If we go with the 900 divided by 1.10, it will work out 900 into 909. 1.10 to the power of 1 is 909 here. If we divide 1 divided by 1.10 to the power of 1 is 909. In the second year, it becomes 826. Third year, 0.751. It is 0.683. Then 0.622 minus investment. If we made all this multiplication, it will work out 2,725. Your investment is 2,600. There is a net present value is 125. Here the net present value is 125, so that the financial plan is accepted. If it is a positive, it is accepted. If it is a negative, it should be rejected. Accepted. Thus, as per the wealth maximization objective, a financial plan which has a positive net present value creates the wealth, therefore it is accepted. It's a positive figure that can be accepted. This is nothing but net present value method. So this is 1 plus r to the power of first year is 0.909, second year 0.826, third year 0.75, fourth year 0.683, minus 2,000. If you made all these total, it will come 2,725. That is inflows, but outflows is 2,600. The net present value is 125. So when it's a positive net present value, you must be accepted the project. If it's a negative, it should be rejected. Wealth management, therefore, it is accepted. At the same time, a financial plan with a negative net present value is rejected. This is important. Positive, accepted, negative, rejected. For mutually exclusive project, the one with the highest net present value should be adopted. For example, in the above illustration, if there are two projects X and Y with initial investment of 2,600 and rupees 2,500 respectively, and X has NP of 125 and Y has NP of 225, then project Y is accepted because it is higher NPV. If you have got two projects called X and Y, when you calculate the NPV at 10% only, one will arrive rupees 2,500, another will be 2,225. Then project Y is accepted because it has higher NPV. When there is a high, it is 125 for X, 220 for Y. Which is the higher one? Y. Y is accepted. It is an accepted principle that the wealth or net present value of the firm will be maximized if This criteria is followed in making the financial decision. Thus, net present value maximization is superior to the profit maximization as an operational objective. It compares the values and cost of the financial decision. It is moreover a precise and unambiguous concept. Wealth man. It is thus a feasible decision criteria for financial management decision. Moreover, the wealth maximization objective is considered with the objective of maximizing the owner's economic welfare. If wealth is maximized, the owners can adjust their cash inflows in such a way so as to optimize their investment. From the shareholder's point of view, the wealth created by the company through its action is reflected in the market value of the company's shares. Therefore, the wealth maximization principle implies that the fundamental objective of the firm should be to maximize the market value of its share, which in turn is in a reflection of the firm financial decision and is the firm performance indicator. Here, this is important. Moreover, wealth maximization objective is considered with the objective of maximizing the owner's economic welfare. So, there are two. One is called profit. The main objective of financial management is profit maximization and the wealth maximization. Both I have explained. So, we take the NPV as the base figure. If we have a two company, X and Y, if X company is lower when compared to Y company, better to accept the Y company. It is more than the cost price of the particular comparison of the company. So net present value should be more than the cost price. Hope you understand financial decision in the firm performance. So here we already explained profit maximization and the wealth maximization. So in the examination, if they have the objective, you have to what's called explain profit maximization also and the wealth maximization also. I have given the detailed notes of the profit maximization and the wealth maximization. I have explained also. In the next class, I will explain the scope of financial management and we'll go for a problem. Till then, goodbye. Meet in the next session.